Hello friends, and in today's video, I'm going to discuss about is there an AI bubble? So this itself will be through all the information I've gathered and so that I can share more with you on the current market outlook. So let's dive right into it. So quick disclaimer, this video is for educational purposes only, not any recommendation for buy sell, and past performance does not guarantee future results. And in today's video, I'm going to share a lot more on facts rather than opinions, so that giving you hard information so that you can come up with your own opinion with regards to the market. So we do a very quick dive into what happened in 2025. So 2025 was still a pretty good stock market performance for the US. And we do see that January to March itself, from calm to shock, was actually when trade tariffs was announced. And April itself was the Liberation Day, when Trump actually came out and said that they are going to slap on tariffs on all the other different countries. Okay, so what happened during that period of time was S&P 500 briefly went down by almost 19%. And subsequent itself, the market rebounded. So the rebound itself, one main thing was US and China announced a pause with regards to the trade wars. And subsequent August to September, we do see that the GDP growth, capex spend actually increased by the big techs. Next, that went his on a new high. Crazy spending on the AI building of the data centers, and subsequent October to December itself, market has all been like rising crazily. So this was actually a lot of volatility during the April to May period, but of course after that itself, market has been performing pretty well. So looking at this S&P 500 chart, that was the Liberation Day during April, and then market has been just on the tear until all-time high. So if you have stayed invested throughout this period of time, do clap for yourself, because you went through a tough period with all the crazy volatility, and Donald Trump was not making things very easy. So however, if you held through, you should have done pretty well for 2025. So what we want to understand as of now is what actually helps the market to continue growing in this manner. I think it's very important that we do have a growing economy, meaning that the GDP is growing. It makes things easier and also ensure that the businesses are really growing profits. And stock market, in terms of stock prices, as long they are growing profits, stock prices tend to follow profits. So this is a relationship that is very important. As long the earnings grow, revenue is growing, stock prices generally move in the same direction. And lastly, with stability in the overall economy itself, no crazy news, basically market will be performing well in a stable economy. So looking at this for the US GDP growth, so the GDP in the US advanced at 4.3% in Q3 2025. So you can see that actually for the US economy, even though with all the news of tariffs and stuff like that, the GDP itself has been growing consistently, which is a pretty good news. And the next part, which is very important, are the corporate earnings. So corporate profits in the US rose by 4.4%. And you can do see that actually profits has been rising steadily throughout this period of time. And it's important that we know that the relationship between earnings and stock prices. So over here, you can see that the orange line are the earnings. Okay, in the for the US top 500 companies, and the blue line itself is actually the stock price. So generally, the higher the earning the company has, stock prices tend to follow in the same pattern, which is what we have been seeing as of now. So for the US stock market earnings growth, we can see that in the year 2021, 22, 23, 24, and 25, growth itself has been pretty high. Okay, it's actually pretty good earnings that we are looking at. And if we follow through with the US stock market performance, you do see outperformance also. Okay, so 2022 was when US Fed rate hiked the actually interest rate. So stock market actually went down, but 2021, 2023, 2024, and 2025 itself, higher earnings, higher revenue, stock prices continue to go up. And let's take a look at the earning guidance in different sectors. So for calendar year 2026, using the source by FedSet, we do see that there are continued earnings growth in IT industry, materials, industrial. Projected earnings growth itself has been very healthy. Okay, and the S&P 500 projected growth going for 2026 is actually 15%. So what we are looking at in terms of the analyst expectation is there's a lot of buy, hold rather than sell in terms of the analyst sentiment. So analyst sentiment itself and expected growth rate of company earnings are pretty strong, which is actually a good sign for the economy. So the signs of growth, I think, is still very valid in the year of 2026. But the most important thing is price still matters. So the whole idea of today's video that we want to discuss is there actually a bubble over here? So I think I want to share this concept over here, which is actually the price to earning ratio. So the price to earning ratio is basically the price of the share divided by the earnings per share. So what you pay for every $1 of earning is basically the P ratio. And a bubble itself only happens right when the P ratio really go crazy and out of the norm. And on top of that, there is actually no earnings growth. So if the ratio are pretty high and there are no earnings, or maybe in terms of like no earnings growth, basically these are signs of bubble. But is that something that we are currently seeing in the current market condition? So what can we see is we have to use a benchmark on the Magnificent Seven. So if today we look at the valuation of Apple, which is the PE ratio chart over here, the median itself is actually at 29.55 for the past 5 years. And we do see that the Apple PE ratio itself is slightly on the higher end. Okay, but it's not at a crazily high amount. Over here, we look at the valuation of Microsoft. Microsoft P itself for the past 5 years is actually about 33. Okay, and we are looking at the current P ratio is slightly below the 5 years median. So this isn't a bubble looking at a price like this. And how about Amazon? For Amazon P ratio itself for the past 5 year median, is actually over here. And you do see that the current P ratio is also below the past 5 years median. And last, looking at Google also. So Google itself has been was actually below the past 5 years median for quite a bit of time until the recently the Gemini Pro breakthrough speculation that they are taking a lot of market share over from ChatGPT, and you see that the prices shot up. But is it at a very crazily high valuation as of now? I don't think so. Not really. And valuation of Tesla has always been highly valued. So as of now, it's of course still above the 5 years median. How about Meta? Meta prices has been recently taking quite a beating. But if we look at the past 5 year median, the prices over here in terms of the P ratio is still not at a crazily high moment, slightly above the 5 years median, but it's not like crazily high until we can see that it's a bubble. Okay, Nvidia. So Nvidia itself, of course, what we can see over here is the 5 year median, and the current P ratio right now is still below the 5 year median. So looking at the summary like this, I think there's still quite a good mix. Microsoft, Amazon, and Nvidia is actually lower than the 5 year median for their current P ratio, and Apple, Google, Tesla, and Meta is slightly above. But we don't see crazily high amount in terms of the PE as of now. So if today you refer back to the dot-com crisis, at that point of time, rather than the Magnificent Seven, the PE ratio of the top 9 large cap companies at that point of time, these are the PE that we are seeing. Everything is above 100. And I think some of the companies you don't really still see it as of now. Okay, and if we are looking at a 100 over PE ratio like previous time, we don't really see this thing happening as of now. And the next thing itself is a bubble doesn't happen in a fearful market. So as of now, the fear and greed index market itself is more on a neutral basis. We are not in the exuberant period where there is actually extreme greed. So if let's say the market itself is actually at the extreme greed phase, I think that is a point of time that would be more dangerous. So as of now, taking a look on the S&P 500 index, this is actually the S&P 500 index in terms of the price, which is the blue line. And the green line is the S&P 500 P ratio. So over here, in terms of this P ratio, if you are looking at the past 10 years, this is actually a one standard deviation movement. So the P ratio itself, right, generally if it's contained within this 10 years one standard deviation, we can see that we are not at the point of time like the COVID period. After the COVID, when the bubble really was booming, then the prices actually went down. But as of now, I think the P ratio is still at a pretty healthy zone. Of course, we wouldn't say that it's priced very cheaply, but I wouldn't say that it is a bubble. So in summary, are we really in a bubble? Based on what we have seen earlier, growing profits, P ratio not too exuberant, price at the higher side, but not really at the exuberant side. So I don't really think that we are in a bubble. But are we undervalued? Definitely not. I think prices are considered on the higher side, but not at a crazy high side. And the last thing that we want to know is, does the economy still have strength? So looking at the GDP growth prediction and the corporate earnings going forward, and S&P 500 predicted earnings itself for full calendar year of 2026 at 15%, I think there are still strength in the market. So looking at this, the next part that we need to understand is more on the headwinds. What do we need to take note of? Okay, so the first thing is a hawkish Fed. So the Fed itself signals that there might be three rate hikes in the cut in 2022. That was in 2022. But when the rate hike happened, the market actually tanked. Okay, so you can see that this line is actually the rate hike, and this is actually the stock market performance. So when the Fed signal in December that the rate hike is going to happen in March, the stock market already went down. So now the next question is, we need to understand, will the interest rate go down or will the interest rate maintain as it is? So right now, looking at what is happening in the market, as long inflation is still being controlled, likely going forward, the Fed itself is going to cut rate, but not at the very accelerated way of like cutting interest rate, but more of like they are trying to see what's the data in the market and then adjust the rates accordingly. But based on current sentiment, the sentiment is more on the rate is going to drop rather than going up. But if inflation comes back again, what happened is that the 2022 situation might happen again. And if that's the case, the whole overall sentiment of the market will start to change. Okay, so a hawkish Fed is something that we need to take note if inflation really goes up again. And looking at the dot plot in December, what we are looking at the FOMC medium forecast itself is that we can see 2025, 26, 27, 28. The projection itself is more on like a downward trending interest rate rather than like we are going to hike interest rate all the way. So that itself is currently based on the dot plot. The market sentiment is more the Fed decided to change direction. That itself will be something that we need to take note. And as of now, we do see that the US core inflation itself is steadily going down, not at the most ideal rate of like below 2%, but it's at a rate as of now that they are comfortable to slowly cut interest rate. But these are data that we have to take note on whenever they are published. And US unemployment rate itself actually has been slowly inching up. And I think that is actually also the push for the US Fed to start revising in terms of the interest rate. Because the Fed itself has only two things that they really want to make sure that it happens in the market. They want low unemployment rate. They also want low inflation. Okay. So these are the things that they will actually guide them in terms of the movement and direction that they're going to go forward with the interest rate. Okay, the next big part of the story is more of, will the hyperscaler capex stop? So looking at this, this is actually the 2025 S&P 500 capex from the hyperscalers. So approximately you can see that 71% is, okay, remaining all the S&P 500 other companies in terms of the capex spend. And a big chunk of it, 30% itself, is actually held by these four companies, the hyperscalers, which is your Amazon, Microsoft, Alphabet, and Meta. So looking at this hyperscalers commitment, I think it's very important that we see that whether this increasing spending of infrastructure will continue. Because I think the first half of the growth of GDP in 2025, the total growth is at 1.6% GDP growth for US. And out of this 1.6%, right, the 1.5% growth in this GDP was actually contributed by the hyperscalers capex. So if spending starts to slow for the hyperscalers, it will definitely affect the overall economy. So taking a look at this hyperscalers commitment, we can see that the Amazon CEO mentioned that they are going to continue to invest in capex, and they want to signal that they might be still increasing the capex until 2027. Mark Zuckerberg saying that 2025 is a pivotal year for AI with 60 to 65 billion capex. And basically, they see that there will be no deceleration up to 2026. So likely 2026, the continued investment into capex is going to be still there. And CFO for Microsoft, same thing. They mentioned that acceleration in the fiscal 2026 of capex up to 94 billion. Then Google update 90 billion for 2025, and commitment for AIs itself until 2026 to 2027. So what we can see over here is that likely the AI capex as of now, I don't think it's very easy to predict whether what will happen in 2027. But looking at the statements that they have been sharing, 2026 itself, most likely AI capex will continue to grow. And this itself will have a cascading effect of the money flowing from the hyperscalers to all the companies in the AI chain. And today we can see that the hyperscalers capex spending actually accelerated really quite a fair bit. So 2022 was the point of time ChatGPT appeared. So at 2022 itself and 2023, we start to see capex growing. And this itself will be actually the four companies, Meta, then Microsoft, Google, Amazon. And 61% growth in 2024, and for 49.8% of capex growth in 2025. And going 2026, I think the prediction itself is capex is still going to increase. And at the same time, there's another new player, which is Oracle. So with this spending itself, right, by the hyperscalers, all the funds itself will start to actually cascade into the people who are making AI possible, which is the infrastructure of building up the data centers. So the spending itself is important because once spending starts to drop or slow, we do see that that itself will start to have an effect on the market when the spending start to slow. But as of now, 2026, it seems like the spending is still going to continue, and companies itself benefiting from this AI story is still going to continue to grow. Okay, and one thing that we have to take note is really more on world stability. Of course, as of now, we do see that Donald Trump itself has been giving up a lot of crazy statements, saying that they want to take over Greenland, and sometimes you can never ever predict what is he going to say on the very next day. But ideally, if let's say there's more peace involved, it's easier for people to make money, economy to continue to grow, a lot more partnerships happening. But these are something that we cannot control. So there's no way to predict what Trump is thinking. Just like last year when Liberation Day happened, nobody knew what is going to happen, and stock market actually went down. But you do notice that when the Liberation Day happened, okay, over here, and the stock market actually went down by quite a fair bit. If at that point of time, you decided to invest in the stock market, okay, this itself are very good opportunities. And if you take a look at what happened is that whenever Donald Trump says something to create a lot of noise in the market, sometimes what we can do is rather than let it create fear for us, we can always use this as an opportunity to buy quality stocks because we know that the earnings of the companies are not being affected by whatever he says, unless what he says actually affect the markets in terms of like corporate earnings. But you think about it, let's say whenever he say that about the tariffs or maybe all the wars or the things that he wanted to start, most of the time companies are still just churning along, making profits, revenue are still growing, and the stock prices becoming depressed at that point of time are always good opportunities for you to scoop up some quality shares at a discount. So rather than trying to guess what Donald Trump is trying to say, make use of the opportunity that he have created so that you can always buy stock at a cheaper price. And there will be a lot of people thinking that, okay, well, Donald Trump is trying to create a lot of trouble in the market, and what if war happens? But you would have noticed that over here, in terms of these timeline charts, there are a lot of wars that happen at many years in terms of all the time. But however, the stock market has always been humming along. And in fact, what I would say is more of whenever Trump says something to create opportunities like this, that will be always good chance for you to scoop up shares at a good discount. So what are the things that we want to look ahead? Okay, I think the first thing is very important is earnings, because earnings itself, like what we've discussed earlier, higher earning, higher stock prices. So looking at the source from FactSet, we are looking at the S&P 500 to going to report double-digit earnings growth for the third straight year. Okay, so expect earnings growth of 50%, and this is basically the 6 consecutive years of earning growth and the third year of double-digit growth. So likely looking at the guidance, as long nothing changes drastically, as long the earnings growth itself, the stock market for 2026 seems going to be positive. And we are looking at the worldwide monetary easing policies also, because for the US itself, you already started to see that they have been doing rate cuts. China has been doing rate cuts. Germany, India, and over here itself, we do see that okay, Japan is increasing interest rate. Then UK is actually decreasing interest rate. France, Italy, Canada, they are all actually cutting rates. Brazil is not cutting rates. But you notice that over here, a lot of time for the reason of cuts. Okay, explicitly cited US tariff, trade tension, tariffs over here. Then over here is like they say tariffs related. All we can see over here was that Donald Trump really created something very powerful here. He created all this uncertainty in the market, and other countries actually started to make the environment easier to do business by trying to provide quantitative easing by cutting interest rate. So looking at that in 2025, what happened in the world? We do see that the MSCI World Index, this is the, okay, over here is the annualized return. Sorry, I think I cut off some of the data over here. So this itself is all the year-to-date return. Okay, these are the year-to-date return. MSCI World is like 20% performed last year. Emerging market 29, Asian market X, Dow Jones itself 14%, QQQ 22, S&P went up by 17%, the Europe market 15, London itself 20%, Nikkei was very well, 27%, Kospi, the Korean market 72%, China 29, HSML 26, Shanghai 18%, Hang Seng Index, even our Singapore market, Straits Time Index. So last year market actually performed pretty well. And we do see that with all the stimulus that all the other countries are doing, this also indirectly help other markets to perform better. So the whole idea is, what do we do with all this information? So of course, if you got a financial advisor, you want to do a discussion with them, you can definitely do so. But the whole idea is, how are we going to prep our portfolio for with all the information that we have gotten earlier? So the main thing is, we do see that the AI call are still here. So the US itself, right now, we can see that, okay, we can say that maybe in terms of like China AI is catching up, they are very strong. But as of now, I think the AI leaders are still in US. So for my own portfolio, I'm still leaning towards the US because I believe that the AI leadership is still in the US. Hence, most of my money will still be in the US. Okay. But the next thing is, looking at last year performance, you start to see that actually other countries itself are creating stimulus into their own country. And in fact, the stock market performance was even better compared to the US. So what we want to do is, if there's a lot of uncertainties in the market, maybe what we can do is not just focus on just one country. We can in fact diversify satellites into other countries for your own portfolio exposure. And other countries right now are also building up their own infrastructure. Okay, due to the fact that they also start to notice maybe US might not be the one that they can just keep on relying, and they want to be more self-sufficient. And in fact, the defense sector from Europe, all this, they also start to put more money into these sectors, because they themselves was thinking, oh, will US still continue to be the big brother to protect their side of the world? Okay, and the AI spillover effect is also very real, because right now we do see that when the hyperscalers are spending, Taiwan is actually the one, TSMC manufacturing the chips. Korea itself, they are manufacturing in terms of like the memory. Europe, ASML, they are making machines for making the chips. So there's a lot of all these good quality companies across the world, which there are a lot of opportunities that we can find other than just holding blindly just purely in US. Okay, and the next part is more of like, if you are someone who haven't really started investing, don't just keep waiting for the perfect time or maybe the big crash. Because if let's say from the crash itself, like if you have been waiting since 2023, 24, 25, it has already been quite a while. And the more important thing is for your own financial portfolio, if you are investing for your own retirement, if your horizon is going to be like 10, 15, 20, 25 years, the best time to start was 20 years ago. But we cannot go back in time. So the next best time is actually now. So looking at this, even let's say, for example, in terms of the Liberation Day, before the Liberation Day happened, let's say assuming you bought at the top rather than the bottom. So earlier, as the example that I shared is if you actually bought at the bottom, you actually would have made about 37%. That itself is definitely great performance. But even if you have bought at the top, it's still fine because from the top itself until today, it's actually still a 16% return. So the more important thing is more of like when you're afraid of investing, ask yourself this question: are you investing like trading for just maybe 6 months, or are you really investing for the next 10, 15, or 20 years? Because even let's say if you bought at the peak in 2022 market, you would have been actually at a very good position till today if you just buy and hold. And lastly, of course, if today you want to start investing and looking at all the facts and information that I've shared with you, the whole idea is not to create greed in yourself, to go all in. Most importantly, what I learned in my investing journey is to actually have proper position sizing. That means if let's say today I really decided to go into a position, rather than just with a gambling mindset thinking that, okay, I want to make the most money in the shortest amount of time and go all in, I'll be the one just sipping tea, chilling, waiting for the good timing. Whenever stock prices pull back, I just want to add on to my positions because I do understand that my time horizon for investment is the next 10, 20, 30 years, which I don't mind holding. Yeah. So rather than being very greedy, trying to look for the next AI story and trying to bet all in on that, just slowly and consistently buy quality companies and don't let greed or fear affect your decision making. So things that you can also take note as of now, I think this is the start of a year. It's also a good time to revisit. So if let's say right now you find that the cash interests are dropping and interest hasn't been that fantastic, this is the point of time that you can start to consider, are there any better opportunities out there in the market? And CPF OA right now is still a very good instrument for you to plan your own retirement. But as of now, I think CPF has changed because right now CPF special account is not is currently still paying at 4%. But however, once you reach 55, there wouldn't be any more CPF special account. So as of now, that means let's say if you are someone who are nearing retirement at 55 and all your funds are just sitting in CPF ordinary account earning at 2.5%, if you're somebody who are comfortable to start investing to look to make your money work harder, CPF ordinary account at 2.5% would be something viable that you can still use these funds to invest for a better return. And lastly, if you are contributing into your SRS account to reduce your tax bracket, your SRS account will be something that you can also utilize to actually start investing. So that will be all that I want to share with you for today's session. So I hope that you gathered some good information out of today's video. And if you like videos like this, do hit on the like and subscribe button so more videos like this will be recommended to you. So I look forward to sharing more with you in the next video.